Well, today we're looking at New Jersey. Governor Phil Murphy yesterday proposing a $38.6 billion budget plan that includes a higher tax on millionaires to generate desperately needed revenue to fund its unfunded pension program and healthcare liabilities. And they want to avoid some downgrades from concerned credit agencies. Well, joining us now is Daniel Solender, Lord Abbett partner and municipal bond group director. And also with us, Amanda Albright, Bloomberg News municipal bond reporter. So, Amanda, what's interesting is ambitious plans, really tough debt situation. Yet if you take a look at David's terminal here, New Jersey bonds actually outperform.
Right. So Phil Murphy is a very credit rating conscious governor. He unveiled his budget yesterday, and it includes a $1 billion surplus. It includes a record pension payment, increased funding for New Jersey Transit. A lot of residents worry about that. But the path to getting his budget off the ground is not going to be an easy one. Democratic leaders are even saying that they're worried about there being too many tax increases on residents and what impact that would have on the state.
Well, and as I recall, his track record on getting budgets through his legislature has not been very strong. I mean, he tried this last year, and it went on for weeks and weeks.
Right. So the millionaire's tax especially might be a sticking point. So last year he was able to get a tax on people earning over $5 million, so a tax on incomes above that. This year he's pursuing a tax on incomes above $1 million, which would affect about 37,000 people. He says that will raise about $447 million. But the question is, whether or not he'll have to compromise again on that this year.
What's confusing to me, though, is that a lot of investors actually like New Jersey debt, Dan. And we talked to David Kotok about this on Monday, and he said that New Jersey is actually his top debt pick.
Take New Jersey. The New Jersey Turnpike just did a bond issue. It was about 4% tax-free. It's a high-tax state, and with the SALT provisions, that bond is very attractive to a New Jersey taxpayer. I like New Jersey Turnpike at 4% tax-free for a New Jersey tax-paying client when the 30-year Treasury is at 3% taxable. That, to me, is a great gift if you're in New Jersey.
Dan, what are your thoughts?
Well, first, thanks for having me. It's an interesting situation for investors, and David's right. He's talking about a little bit of a different situation where the New Jersey Turnpike's a separate entity and a separate credit. But overall, with New Jersey, the situation is the state clearly needs money, either through revenues or cutting expenses. They have to do something because they have to fund their pension and fund infrastructure. But for an investor, in looking at this, it's not like this is going to default. And the credit rating is A-. It's not in a great range, but investors are viewing it as much lower. The way that bonds trade, they have a much higher yield than a typical A- bond. So as an investor, I'm looking at this saying, they're trying to do things. I get a lot more yield than I would get on a typical A- bond. So it could be a decent investment in certain environments.
So how big is their pension problem as a practical matter? Is there any path to actually addressing it?
The pension problem is a big one because they have to fund it. I mean, they're way down. New Jersey and Illinois are way below other states in terms of their pension funding. And it's not just one governor. It's going back many governors, and New Jersey has not been funding this for a long period of time. So the payment has to increase, and they have to find ways to cut expenses in their pension, too, to make it grow. So it is an issue. It's not an issue that's going to cause a default or a big cash flow funding problem in the next couple of years. It's something 10, 20, 30 years in the future that could be a big issue.
So it's one thing to raise revenue through this millionaire's tax, which is questionable whether you can get it through. What about cutting costs? I mean, whether it's pension costs or other costs.
Absolutely. So Murphy did highlight in his budget that he's seeking efficiencies. One area that he's trying to do that is with healthcare costs. That's another big liability for governments. Interestingly enough, he is still making these investments in the progressive, or trying to make these investments in the progressive issues that he promised, K through 12 education, pre-K. But the problem is that the amount of debt payments and pension payments, it's starting to crowd out these services and his ability to invest in them.
Well, also you mentioned, Dan, that it's trading worse than the situation is in terms of its credit rating. But what if they lose their credit rating? I mean, S&P Global Ratings says the extended revenue shortfalls in the first half of the year will make catching up by the end of the year more difficult, even if currently slow revenue trends reverse. If they cut, can you still find the muni interesting?
Well, that's the thing. In the last administration, the rating kept being cut consistently throughout the administration, so it's been going down for a while and trending negative. It's been stabilizing a little bit, but it is the kind of thing where the market is viewing it as it already is, viewing it as if it's already been downgraded. So it's not something that's going to go below investment grade. It's nowhere near that kind of range. But I think the anticipation is if they don't improve things, they're going to be downgraded.
So something we referred to earlier is the SALT tax and the effect that may have on people's interest in investing in bonds. Are they being artificially, to some extent, supported affected by the SALT exclusion?
So it's really interesting. I spoke to an investor yesterday who said there's kind of two markets for New Jersey debt. You have the local towns, the commuter towns to New York City, where there's a lot of wealth, a lot of AAA rated credits on the local level. Those trade really rich because of this dynamic where people really want tax shelters like munis. And then you have the state related credits. Those do trade a little bit cheaper, as Dan was talking about.
Dan, what's the risk that the high-income earners are just going to leave?
That is the risk, but we've been through this for a while, and people want to be in this area. There are a lot of jobs here. They have families here. There's a lot of reasons to be here. So there is a certain point when people will leave. The question is where that is. Anecdotally, you keep hearing people. I live in New Jersey. Keep hearing people say their neighbors are complaining and leaving, but the numbers aren't showing it so far. Since it's not showing up, it's a thing we have to keep watching. It's a big impact in the future, but so far it's holding off.
Is there anything unique about the New Jersey situation, or is this similar to Illinois and other places?
What's unique here is that just the structure of the debt's a little bit different in New Jersey, where they don't have a lot of general obligation bonds. They have a lot of bonds that are subject to appropriation every year. Oh. So the structure of the bonds are a little bit different, which makes things different. And just the economy is doing well here, so it's not a bad economy. It's not growing as fast as the rest of the country, but it's in a good location to be near New York.